As a company, do you want your employees to compete or to cooperate? Especially when it comes to the asset management industry, in which funds are run by portfolio managers, you would think that since they have to beat the market, they have very competitive incentives. Yet we find in this paper that there's a lot of variation across asset management companies. Some mutual fund families are more cooperative in nature and have cooperative incentives in place, and others are very competitive and have competitive incentives in place. This is what we study in this paper. Those that are very cooperative, they effectively act as a family. They help each other out in times of distress. So when a fund faces redemptions, other funds provide liquidity to that fund in that fund family. Or trades are being settled within the fund family. So when a fund family has more cooperative incentive structure, you would see that type of behavior manifest itself. Some fund families have competitive incentive structure. And then you see that the average fund does much better, but there's also a lot more dispersion in the performance. So this makes this type of incentive structure appropriate for a clientele that is more institutional based. Versus the fund families that are more cooperative, they tend to have a clientele that is more retail oriented. So there is less dispersion in the performance, and the average retail investor would be better off within that incentive structure of that family. So to answer the question, should you incentivize them to compete or cooperate as an asset management company? The answer is depends on your clientele. That's what we find in this paper, which was part of the Knowledge Center in Finance and Nova SB.